Hello, savvy investors. It's Iggy here, your go-to guide from Investing Iguana. Today, we're diving into the world of REITs as the earnings season kicks off. In this video, titled REITs Earnings Season, Key Insights for Singapore Investors, I'll be shedding light on the key factors influencing Singapore's REIT market as we navigate the complexities of 2024. From analyzing the impact of rising interest rates and inflation to exploring strategic moves by top REITs, I'll provide you with essential insights to make informed decisions. Whether you're a seasoned REIT investor or just getting started, this is your opportunity to stay ahead in the game. So, let's unravel the secrets of thriving in this season's REIT earnings. So, what should you, as a savvy investor, keep an eye out for in REITs? Let's break it down into 4 critical areas. 1. Operating expenses. Operating expenses are a critical aspect of running a business, encompassing costs such as staff salaries and utility bills. These expenses can fluctuate significantly due to various factors, with inflation being a key driver. For instance, last year, we witnessed a surge in inflation rates, which had a profound impact on operating expenses across various industries. One notable example of this impact is the Mapletree Pan-Asia Commercial Trust, MPACT. This organization experienced a substantial increase in their property operating expenses in the second quarter of the fiscal year 2024. The increase was not a minor one, it was a massive jump of 14.8%. This spike was primarily driven by utility expenses, which more than doubled during this period. For investors, these are crucial details to keep an eye on. Operating expenses directly affect a company's profitability, and a sudden increase in these costs can significantly impact the return on investment. Therefore, as an investor, it's essential to monitor these expenses closely. Investors who have put their money into Mapletree Pan-Asia Commercial Trust, MPACT, need to be particularly observant of potential utility contract renewals. This is because utility expenses have recently seen a significant surge. If there are any changes in these contracts, it could lead to a further increase in costs. Utility expenses form a substantial part of the operating costs for any business. In the case of MPACT, these expenses have more than doubled recently. This sudden and significant increase can have a considerable impact on the company's bottom line. Therefore, any changes in utility contracts, which are a major component of utility expenses, could lead to a further escalation in costs. As an investor, staying informed about such developments is not just important, it's essential. It's key to making sound investment decisions. Investors need to be vigilant about potential changes in utility contracts. They need to keep an eye on the market trends, regulatory changes, and the company's plans regarding these contracts. Being proactive in this regard can help investors anticipate potential changes in costs and adjust their investment strategies accordingly. It can also help them better understand the company's financial health and its ability to manage its expenses effectively. 2. Finance costs. Finance costs, which primarily consist of interest payments on loans and bonds, are a significant concern for businesses, especially in an environment where interest rates remain high. These costs can have a substantial impact on a company's profitability and cash flow, making them a key factor for investors to monitor. Take, for instance, Elite Commercial REIT and Digital Core REIT. Both of these real estate investment trusts have seen their finance expenses shoot up significantly. This increase in finance costs can be attributed to the high interest rate environment. Higher finance costs mean that these companies are spending more on interest payments, which can eat into their profits and potentially affect their ability to pay dividends to investors. However, it's not all doom and gloom in the world of finance costs. Some companies have managed to moderate their borrowing costs despite the high interest rate environment. A prime example of this is Mapletree Logistics Trust. This company has seen a moderation in its borrowing costs, which is a positive sign. It suggests that the company is effectively managing its debt and finance costs, which can be beneficial for its profitability and attractiveness to investors. As we approach the upcoming earnings season, it's crucial for investors to keep a close eye on these finance costs. Changes in finance costs can provide valuable insights into a company's financial health and its ability to manage debt. Moreover, they can also give investors a better understanding of the company's future prospects, especially in terms of its profitability and ability to pay dividends. 3. Gearing level and fixed debt proportion. The gearing level and the proportion of fixed debt are 2 crucial financial metrics for any real estate investment trust, REIT. Let's delve deeper into these concepts to understand their significance. The gearing level, also known as the debt-to-equity ratio, is a measure of a company's financial leverage. It indicates the proportion of the company's capital that is financed by debt. A higher gearing level means that a larger portion of the company's capital is financed by debt, which can increase the company's risk. In the case of REITs, there is a cap on the gearing level, typically set at 50%. If a REIT's gearing level is too close to this cap, it can limit the REIT's ability to borrow more in the future. This can be a significant constraint, especially if the REIT needs to finance new acquisitions or other investments. On the other hand, the proportion of fixed debt refers to the amount of debt that is locked at a fixed interest rate. In times of rising interest rates, having a higher proportion of debt at fixed rates can act as a buffer. This is because the interest payments on this debt will not increase even if market interest rates go up. Therefore, a higher fixed-rate portion can help protect the REIT's profitability from interest rate hikes. Mapletree Logistics Trust and Mapletree Industrial Trust are good examples of REITs that have managed their debt effectively. Both these REITs have substantial portions of their debt at fixed rates. This means that even if interest rates rise, the interest payments on this portion of their debt will remain unchanged. This can help shield their profitability from the impact of rising interest rates. In summary, the gearing level and the proportion of fixed debt are key financial metrics for REITs. Investors need to monitor these metrics closely, as they can provide valuable insights into the REIT's financial health and its ability to manage its debt effectively. Especially in times of rising interest rates, these metrics become even more critical. Therefore, as an investor, it's important to understand these concepts and keep a close eye on them when evaluating REITs. 4. Plans for acquisitions, or AEIs. When it comes to real estate investment trusts, REITs, plans for acquisitions and asset enhancement initiatives, AEIs, are often the most exciting aspects. These strategic moves can be game changers, significantly altering the trajectory of a REIT's growth and profitability. Acquisitions refer to the process of purchasing new properties to add to the REIT's portfolio. This can lead to an increase in the REIT's assets and potentially boost its income if the acquired properties generate higher rents. Moreover, acquisitions can also diversify a REIT's portfolio, reducing its risk by spreading its investments across different types of properties and geographical locations. On the other hand, AEIs involve making improvements to existing properties to enhance their value. These initiatives can range from minor upgrades to major renovations. The goal is to make the properties more attractive to tenants, which can lead to higher rents and occupancy rates. In turn, this can increase the REIT's income and boost its distribution per unit, DPU, which is the income distributed to investors. For instance, consider the case of Mapletree Logistics Trust. This REIT has been proactive in acquiring properties across Japan, South Korea, and Australia. These acquisitions have expanded its portfolio and diversified its investments, positioning it for potential growth in these markets. Similarly, Frasers Centrepoint Trust has undertaken an AEI on Tampines 1, one of its properties. This initiative shows the REIT's commitment to enhancing the value of its existing properties, which can make them more attractive to tenants and potentially lead to higher rents. Therefore, plans for acquisitions and AEIs are crucial aspects to consider when evaluating REITs. They can significantly impact a REIT's growth prospects and profitability. Therefore, as an investor, it's important to keep a close eye on these plans and understand their potential implications. And that's a wrap on our journey through the REITs earnings season. Thank you for joining me, Iggy, on this insightful exploration. If you found these insights valuable, don't forget to hit that like button and share this video with your fellow investors. Your support is what keeps Investing Iguana thriving. Haven't subscribed yet? Make sure you do, so you don't miss out on any future updates and analyses that can help you navigate the dynamic world of investing. Remember, knowledge is power, especially in the realm of REITs. So keep learning, keep investing, and stay tuned for more from the Investing Iguana channel. Happy investing, and see you in the next video.